Welcome back. Joining us virtually this afternoon, our financial expert, Nick Sapienza. Nick, good afternoon.
Hey, Taylor. Good to be back.
It is good to have you back. So today we are talking about retirement. So what should people at home know if they are nearing retirement or in retirement financially?
I think that one thing that they should really be looking out for right now, people especially that are in retirement in the early stages or very close to it, is the concept of inflation and really baking that into their financial plan. It's something that a colleague of mine out of New Orleans, Blair Duquesne, wrote about on thebellcurve.com. But we have inflation in the low yield world, and so they have to figure out this puzzle for their portfolio. And think about this, there are 10,000 people retiring in this country every day with no specific written income plan for growing their income at a premium to the growth of their living costs. And most people, or I'd say a lot of people, are coming to us with the idea of safeguarding principal, when in reality, that's not the problem. The problem is preserving purchasing power. That's going to be most important. Now, most people are saying, look, I'm really close to this date where I'm going to be relying on this nest egg that I've built over the last 30 or 40 years. It's a reasonable fear to have, to be afraid of those fluctuations, but you need to be more focused on the long term. So we're trying to help them, kind of zoom out a bit, focus on the big picture. And focus on adjusting their plan for rising income costs. We really, think about it. We need a 3-decade income stream that's going to be capable of maintaining those retirees with dignity and independence through a long and happy retirement. Now, there are things you can do. You can add high quality dividend stocks. That's of course going to increase the risk. Most importantly, the point that I want to make is don't chase yield. People are going after master limited partnerships right now to no avail. They're chasing performance, and most importantly, I would also say just stay away from these sophisticated, high-cost illiquid products. The point that I'm really trying to make is really just to make sure that you actually have a written income plan in place, that you understand the cash flows and how they're going to be coming to you. And if you don't, maybe that's a reason for you to seek a second opinion. Last point that I'll make comes from Barry Ritholtz, who's our Chief Investment Officer, and I'm paraphrasing, but he makes an excellent point when he says that the best strategy isn't the one that generates the highest return. That sounds counterintuitive, but really think about it. The right plan is going to be the one that an investor can live with through the short-term ups and downs. That's going to be most important to their success.
Yeah, that is great advice. And we have a little bit of time left. So is it really, if someone, maybe they're not near retirement, is it ever too late to start a retirement in about 30 seconds? I know it's a lot to fit in probably.
Not necessarily, because it's really focused on the goals. If it's too late, no. The money's going to have a purpose no matter what. I think people just need to really wrap their heads around the fact that people are living longer, that you could be living 20 or 30 years. It's not like the days when Mama and Papa would quit working and then pass away shortly thereafter. That's really not the situation that we're seeing anymore. So it doesn't have to be specific for retirement. It could be for the next generation, but it's really never too late in that sense. Good question.
Great advice as always, Nick. Thank you so much for joining us virtually today.
Thanks, Taylor.
And if you guys at home want to rewatch this advice, be sure to head to our website, klef.com. Before we go to break, though, let's send it on over to Corey Smith.